The American housing market in 2025 isn't just cooling, it's imploding. Cities that once symbolized wealth, growth, and opportunity have become financial graveyards where investors watch fortunes evaporate. From San Francisco's million-dollar homes losing $200,000 overnight, to Florida markets drowning in $8,000 insurance bills, to Detroit's endless vacancy wastelands, the crash is brutal and unforgiving. Inventory is exploding, foreclosures are creeping back, and desperate sellers slash prices by $50,000 to $100,000 with no buyers in sight. This isn't a correction, it's a collapse. These are the 10 worst cities in America where real estate investments are turning into a one-way ticket to financial ruin. Number 10. Portland, Oregon. Portland was once marketed as the West Coast's quirky, eco-friendly paradise. But in 2025, real estate investors are discovering it's become a financial nightmare. The city's median home price hovers near $520,000, yet average household incomes are just around $78,000, creating a crushing affordability gap. With mortgage rates sticking around 6.8% to 7%, the monthly payment on a median Portland home is over $3,300, while the average renter pays about $1,750. That rental yield is under 4%, far below the 6 to 7% investors look for. It means landlords are bleeding cash, hoping for appreciation that simply isn't happening. Inventory has ballooned by more than 15% year over year, and homes that used to fly off the market in under 2 weeks now sit for an average of 42 days. Sellers are panicking, slashing prices by 8 to 12%, but buyers aren't rushing in. Rising crime, homelessness, and tax pressures only add fuel to the fire. Downtown vacancy rates are staggering. Office occupancy is below 55%, a symptom of Portland's fading business confidence. Investors who bought condos or downtown apartments during the pandemic hype are now staring at double-digit losses. Property taxes are no relief either. A $520,000 house racks up nearly $6,200 annually in taxes, while insurance premiums, especially for fire risk areas, have climbed 20% in the past 2 years. Many investors who bought multifamily units expecting cash flow are watching their expenses spiral out of control. Add in Oregon's strict rent control laws, capping annual rent hikes at about 7% plus inflation, and landlords are trapped in a financial chokehold. Portland's once booming reputation has cracked wide open. For investors, this isn't a mild slowdown. It's a market where your capital goes to die. Portland in 2025 has turned from a hipster housing haven into one of the most unforgiving money pits in the U.S. Number 9. Carlsbad, California. Carlsbad, the so-called Village by the Sea, was once one of Southern California's dream real estate spots. Investors bought into the postcard lifestyle, oceanfront views, luxury homes, and a booming tourism economy. But in 2025, it's a trap. The median home price sits at a staggering $1.27 million, while the median household income is only about $115,000. That means even well-paid professionals are priced out, with a mortgage on the average Carlsbad home costing nearly $7,800 a month at current 7% rates. Renters don't provide relief either, with average monthly rents hovering around $3,200, barely covering half of what investors owe. Inventory in Carlsbad has surged nearly 20% compared to last year, and luxury homes are sitting unsold for an average of 65 days, up from just 21 days during the pandemic frenzy. Price cuts are brutal. Listings once marketed at $1.5 million are being slashed by $200,000 to $300,000 just to attract attention. Investors banking on short-term rental income are being crushed too, as new California restrictions and high hotel competition have slashed occupancy rates. Vacation rentals that used to generate $80,000 a year are now pulling in barely $50,000, leaving many owners in negative cash flow. Add in California's punishing tax climate. Property taxes on $1 million home average $12,500 annually, while insurance premiums in coastal areas have soared past $6,000 a year, with wildfire and flood risks pushing some policies even higher. HOAs in upscale communities tack on another $400 to $600 per month. its death by 1,000 cuts. Carlsbad's shimmering beaches and family-friendly image hide a harsh reality. Investors are drowning in costs, with appreciation stalling and expenses skyrocketing. What was once a golden investment has soured into a financial quagmire, making Carlsbad one of the worst bets for real estate in 2025. Number 8. Fort Myers, Florida. Fort Myers was once the poster child of Florida's post-pandemic boom. Investors flocked here when prices surged nearly 60% from 2020 to 2022. But in 2025, the tide has turned sharply, and it's ugly. The median home price, which peaked near $420,000, has already dropped to $370,000, a 12% year-over-year decline, one of the steepest in the nation. Homes are piling up on the market, with inventory up nearly 30%, and sellers are slashing prices by $20,000 to $50,000 just to get offers. The affordability crisis is glaring. Household incomes average $70,000, but at today's mortgage rates, the monthly payment on a median home sits at $2,650, far beyond local budgets. Investors who bought at the top are underwater, and foreclosures are creeping back. In fact, foreclosure filings in Lee County spiked by 18% this year, raising fears of a repeat of the 2008 crash that devastated this region. Insurance is the dagger. Florida's property insurance premiums have exploded, with Fort Myers homeowners now paying $5,800 to $7,500 annually, double what they paid just 3 years ago. Some insurers have pulled out entirely, leaving owners scrambling for coverage. Add to that the lingering scars of Hurricane Ian in 2022, and buyers are hesitant, pushing prices even lower. Rentals aren't much of a savior either. Average rents sit at $2,000 to $2,200, far below the cost of ownership. Many Airbnb operators are seeing occupancy rates collapse as supply outpaces demand. Investors banking on quick flips or passive rental income are discovering Fort Myers is bleeding cash instead of printing it. Once hailed as Florida's hotspot, Fort Myers is now a glaring warning sign. Oversupply, collapsing values, and punishing insurance costs have turned it into one of the worst markets for real estate investors in 2025. Number 7. Baltimore, Maryland. Baltimore tells a chilling story of urban decline that makes real estate investors shudder. The median home price here is relatively low at $220,000, but don't be fooled. Cheap doesn't mean profitable. With household incomes averaging just $58,000, affordability should be easy, but rising crime, depopulation, and vacancy plague the city. Roughly 15% of all Baltimore homes are vacant, one of the highest rates in the country. Investors who thought they were buying undervalued assets are stuck with properties that won't appreciate. Rental yields look attractive on paper, with median rents at $1,500, but reality bites. Tenants often struggle with payments, eviction processes are slow, and maintenance on aging row houses eats up profits. Vacancy rates in certain neighborhoods are over 20%, leaving landlords carrying mortgages without rent coming in. Meanwhile, property taxes are brutal. Around $2,600 annually on a $220,000 home, one of the highest effective rates in the U.S. Baltimore's crime rate is another major drag. The city reports nearly 1,900 violent crimes per 100,000 residents, more than triple the national average. Investors avoid certain zip codes entirely, knowing resale values will never recover. Even in revitalization zones, homes bought for $180,000 in 2021 are now reselling for $160,000, a backward slide. Add in declining population, Baltimore has lost nearly 40,000 residents since 2010, and the picture gets worse. Insurance premiums have jumped 15% in just 2 years, further eroding profitability. For investors, Baltimore isn't just risky, it's a graveyard for capital. What looks like affordable entry points quickly turns into a money pit of unpaid rents, endless repairs, and properties that barely hold their value. In 2025, Baltimore has become a textbook example of why low prices don't always equal good investments. Number 6. Houston, Texas. Houston, often called the energy capital of the world, is turning into an investor's trap in 2025. The median home price sits at about $340,000, but the city's affordability advantage has eroded under today's mortgage rates. A 30-year loan at 6.9% drives monthly payments to nearly $2,250, while household incomes average just $72,000, leaving buyers stretched thin. Inventory has ballooned by 25% year over year, with homes sitting for an average of 52 days, almost double the 2022 pace. Price cuts are common, with sellers slashing $15,000 to $40,000 to attract offers. Investors face another crisis: oversupply. Houston's relentless construction boom flooded the market with new builds, many priced in the $400,000 to $500,000 range, that now sit unsold. Builders are offering desperate incentives like $20,000 in buyer credits and rate buydowns, undercutting private investors trying to resell. Rents aren't much better. Average rent for a 3-bedroom house is about $1,950, far below carrying costs, leaving landlords with negative cash flow. Taxes add fuel to the fire. Texas has no income tax, but Houston makes up for it with punishing property levies. A $340,000 home racks up over $6,800 annually in property taxes. One of the highest effective rates in the U.S. Insurance is equally brutal. Wind, hail, and flood coverage can top $4,500 a year, and some neighborhoods near flood zones have seen premiums jump 30% in 2 years. Houston's economic dependency on oil creates volatility. Layoffs in the energy sector have dampened demand, while office vacancy in the downtown core hovers around 28%, reducing confidence in the city's long-term stability. For investors who once saw Houston as a growth powerhouse, 2025 is exposing the harsh reality: too much inventory, too many costs, and too little return. Number 5. Punta Gorda, Florida. Punta Gorda looks like a charming Gulf Coast escape, but behind the palm trees lies one of the worst markets for investors in 2025. The median home price peaked at $410,000 in 2022, but has since crashed to $368,000, a staggering 10% decline year over year, making it the sharpest drop in the U.S. Inventory has exploded by nearly 35%, and sellers are cutting $25,000 to $60,000 off listings just to get attention. Affordability is collapsing. With average household incomes around $65,000, the monthly payment on a median home now runs over $2,600, impossible for most locals. Foreclosure filings in Charlotte County are up 22% this year, bringing back haunting echoes of 2008. Homes that once sold in days now sit for 70-plus days, with price-reduced banners littering online listings. Insurance is a nightmare. Florida premiums have doubled since 2020, and Punta Gorda is ground zero. Annual homeowner insurance bills often exceed $7,200, with flood insurance adding another $1,500 to $2,000 depending on the property. Many insurers have exited the region entirely, forcing residents into state-backed citizens' policies with skyrocketing rates. For investors, these costs obliterate any chance of positive cash flow. Rentals don't save the math. Average rents are just $1,900 to $2,100, far below ownership costs. Short-term rentals, once a goldmine, now suffer from oversupply as thousands of Airbnbs flood the Florida coast. Occupancy rates are sinking, with many hosts reporting income drops of 25 to 30% year over year. Punta Gorda's beauty hides a brutal truth: falling values, surging foreclosures, and unsustainable insurance costs make it one of the most dangerous real estate markets in 2025. Investors, expecting Florida sunshine profits, are instead burning in financial quicksand. Number 4. Cape Coral, Florida. Cape Coral was once the darling of Florida's pandemic housing boom, where home values soared over 70% from 2020 to 2022. But in 2025, it's become a disaster zone for investors. The median home price, which peaked at $435,000, has plunged to around $395,000, a 9% year-over-year decline. Inventory is exploding, up nearly 40%, with rows of for sale signs signaling panic. Homes now sit for an average of 75 days, triple the pace seen at the height of the boom. The affordability mismatch is glaring. Household incomes average $68,000, yet the monthly mortgage on a median home runs nearly $2,800 at 7% rates. Foreclosures are climbing, with filings up 20% this year, and distressed sales are making headlines. Some sellers are taking losses of $80,000 to $100,000 compared to purchases made just 2 years ago. Insurance costs are suffocating. Homeowners are paying $6,500 to $8,500 annually for property insurance, with flood and hurricane risk premiums climbing sharply after Hurricane Ian. Many insurers have abandoned Southwest Florida, leaving owners scrambling for overpriced state-backed coverage. Combined with property taxes averaging $6,000 annually, carrying costs are unbearable for investors. Rental income can't fill the gap. Long-term rents average about $2,100 to $2,300, not enough to cover mortgages and insurance. The short-term rental market is also oversaturated, with thousands of Airbnbs fighting for fewer tourists. Many investors who banked on $50,000 a year in rental revenue are barely hitting $30,000 in 2025. Cape Coral's once booming paradise has turned into a real estate cautionary tale. Investors who bought at the top are trapped, watching values slide and costs explode. With surging inventory, rising foreclosures, and crushing insurance premiums, Cape Coral has transformed into one of the deadliest markets for real estate investors in 2025. Number 3. New Orleans, Louisiana. New Orleans, a city famous for Mardi Gras parades and jazz-filled nights, is now infamous among investors as a market collapsing under the weight of risk and cost in 2025. The median home price, which once touched $300,000, has dropped back to around $265,000, a 12% decline year over year. That might look like a buying opportunity, but it's a trap. Mortgage rates near 7% push payments on even modest homes to $1,900 a month, while the average household income in the city is only about $53,000. That means nearly 43% of income is swallowed by housing, far beyond affordability guidelines. But the real dagger is insurance. New Orleans is ground zero for flood and hurricane risk, and premiums have skyrocketed. Homeowners now pay between $7,500 and $10,000 annually, with flood insurance adding another $1,500 to $2,500. Some insurers have pulled out entirely, leaving residents to scramble for coverage through state-run policies at crippling rates. Investors who bought multifamily rentals expecting positive cash flow are drowning instead, as rental yields don't match the soaring costs. The average rent for a 3-bedroom hovers around $1,600 to $1,700, well short of covering mortgage and insurance payments. Vacancy is another plague. Nearly 20% of properties in some neighborhoods sit vacant, either from storm damage or disinvestment. Meanwhile, crime remains a major deterrent. Violent crime rates here are more than twice the national average, scaring off both buyers and renters. Tourism, the city's lifeline, has also softened due to higher travel costs and safety concerns, leaving short-term rental operators struggling. Many Airbnb owners report income declines of 25 to 35% compared to just 2 years ago. Investors who bought into New Orleans' culture capital narrative now face a sobering reality: collapsing values, unaffordable insurance, and chronic risks. The Crescent City has turned into a financial storm zone, making it one of the worst markets to stake real estate money in 2025. Number 2. Detroit, Michigan. Detroit has been a case study in urban decline for decades, but in 2025 it remains one of the worst places to invest. Median home prices hover around $80,000 to $90,000, some of the cheapest in the nation. But cheap is not the same as profitable. Nearly 20% of all homes sit vacant, a staggering figure that translates into endless blight. Rental yields look great on paper, with median rents at $1,100 to $1,200, suggesting double-digit returns. But the reality is brutal: high tenant default rates, costly evictions, and constant repairs. Many homes are over 70 years old, with maintenance swallowing thousands annually. Investors who buy 5 houses for the price of one in another city often find themselves losing money on all of them. Population decline is relentless. Detroit has lost nearly 40% of its residents since 1950, and even today, the city continues bleeding people. The population now sits near 620,000, down from over 700,000 just 15 years ago. This exodus crushes housing demand and ensures long-term appreciation is almost non-existent. Taxes are punishing for such low-value properties. A modest $80,000 home can rack up $2,800 annually in property taxes, one of the highest effective tax rates in America. Add insurance costs that have risen 15% year over year, and landlords are suffocated by expenses. Crime adds another layer of risk. Detroit reports nearly 2,000 violent crimes per 100,000 residents, among the worst in the nation. Investors are terrified of sinking money into neighborhoods where resale values collapse and break-ins are routine. In 2025, Detroit remains a cash-burning trap. What looks like a bargain city for investors is, in reality, one of the most dangerous money pits in America. Number 1. San Francisco, California. San Francisco, once the crown jewel of U.S. real estate, has turned into the ultimate investor disaster by 2025. The median home price is still an astronomical $1.4 million, but values have fallen nearly 12% in the past year, wiping out billions in equity. Inventory is climbing, up 25% year over year, with luxury condos and single-family homes alike sitting on the market for 75-plus days. The affordability gap is jaw-dropping. Median household income is about $136,000, yet the monthly mortgage on a median-priced home is $9,200 at 7% rates. Even high earners can't justify the costs, and tech layoffs have only worsened the demand problem. Companies cutting staff and pushing remote work have left office towers half empty, with downtown vacancy rates above 30%, crushing confidence in the city's future. Rentals are no savior. The average 2-bedroom apartment rents for $3,700, far below ownership costs. Landlords face strict rent control laws, limiting annual increases to around 3%, while expenses skyrocket. Property taxes average $16,000 a year on a $1.4 million home, while insurance and HOA fees add thousands more. Investors banking on Airbnb revenue are hurting, as tourism hasn't fully recovered, and new city regulations slash short-term rental profits by 20 to 30%. Crime, homelessness, and quality of life issues add fuel to the fire. Retail districts are plagued with shuttered stores, and out-migration continues. San Francisco lost over 50,000 residents in the past 3 years, driving demand down further. For investors, San Francisco is a catastrophic mismatch: sky-high prices, falling values, suffocating regulation, and shrinking demand. Once the hottest market in America, it is now the single worst city for real estate investors in 2025, a place where even million-dollar bets are guaranteed to burn.